Preparing for a financial analyst at Bank of America interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Bank of America? I am attracted to Bank of America because finance here sits close to real business decisions across consumer banking, wealth management, markets, and corporate banking. As a financial analyst, I would get exposure to planning, performance analysis, risk-aware decision-making, and senior stakeholder communication. I also like the firm's responsible growth philosophy because it emphasizes profitability, controls, and client focus together. That matches how I think finance should support sustainable business performance. While answering, focus on Bank of America's scale, responsible growth strategy, strong finance function, exposure to banking products, and your interest in turning financial data into business decisions. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows profitability over a period, the balance sheet shows financial position at a point in time, and the cash flow statement explains cash movement. Net income flows from the income statement into retained earnings on the balance sheet and starts the cash flow statement. Non-cash items like depreciation are added back in operating cash flow. Changes in assets and liabilities affect cash, while financing decisions change debt, equity, and cash balances. Make sure to cover the income statement, balance sheet, and cash flow statement, then clearly explain net income, depreciation, working capital, debt, equity, and retained earnings linkages. Question 3. How would you analyze a significant monthly variance between actual results and forecast? I would first confirm the data is accurate and compare actuals against forecast at the right level, such as product, region, cost center, or account. Then I would separate drivers, volume, pricing, rate changes, timing, mix, or one-time items. For example, higher expenses may reflect accelerated hiring rather than structural overspend. After speaking with the business owner, I would summarize the root cause, quantify impact, and recommend whether the forecast needs adjustment. In your answer, talk about isolating volume, price, rate, timing, mix, and one-time items, validating data, partnering with business owners, and explaining the variance in decision-useful language. Question 4. What are the key drivers of revenue and profitability for a large bank like Bank of America? For a bank, profitability is driven by net interest income, fee revenue, credit quality, expenses, and capital efficiency. Net interest income depends on loan balances, deposit costs, asset yields, and the rate environment. Fee income comes from cards, investment banking, wealth management, and transaction services. Credit losses can materially affect earnings, especially in weaker cycles. I would also watch expense discipline through the efficiency ratio and returns such as ROA, return on equity, and return on tangible common equity. Be sure to mention net interest income, loan and deposit balances, rates, fee income, credit costs, operating expenses, efficiency ratio, capital requirements, and business mix across segments. Question 5. How would rising interest rates affect Bank of America's financial performance? Rising rates can help a bank if asset yields reprice faster than deposit costs, expanding net interest margin. Bank of America has historically discussed asset sensitivity, so higher rates may lift net interest income. But the benefit is not automatic. Deposit betas can rise, loan demand may slow, securities values can fall, and borrowers may face higher credit stress. I would analyze the rate shock across NII, funding costs, fair value impacts, and credit quality together. While answering, focus on asset sensitivity, loan yields, deposit costs, net interest margin, customer behavior, securities portfolio valuation, credit risk, and why the impact is not automatically positive. Question 6. What financial metrics would you monitor in a banking FP&A role? I would track revenue, expense trends, operating leverage, forecast accuracy, and business unit profitability. For a bank specifically, I would monitor net interest income, net interest margin, deposit trends, loan growth, non-interest income, provision expense, net charge-offs, and allowance coverage. I would also watch the efficiency ratio because it links revenue generation to cost discipline. On the balance sheet side, CET1 capital, liquidity coverage, and funding mix are critical for risk-aware planning. Make sure to cover both universal finance metrics and bank-specific metrics, including revenue growth, expense run rate, efficiency ratio, net interest margin, charge-offs, reserves, capital ratios, and liquidity indicators. Question 7. Explain the difference between budgeting and forecasting. A budget is the formal financial plan usually set annually, while a forecast is a rolling view of where results are likely to land based on current information. The budget creates targets and accountability. The forecast helps management respond to changes. If card spending, headcount, or funding costs move differently than planned, the forecast should update assumptions. A strong analyst understands both. Budget discipline matters, but forecasts must stay honest and decision-oriented. In your answer, distinguish fixed annual planning from dynamic updates. Explain ownership and assumptions, and show how both tools support resource allocation, performance management, and business accountability. Question 8. Tell me about a time you used Excel or data analysis to solve a business problem. In a prior project, I analyzed department expenses that were consistently above plan, but poorly explained. I pulled transaction-level data, cleaned vendor names, grouped costs by category, and built a pivot-based dashboard showing monthly run rate and outliers. The analysis showed that temporary contractor costs were being coded across multiple accounts, hiding the true driver. After presenting it, the team renegotiated staffing plans and improved forecast accuracy for the next quarter. Be sure to structure your answer using situation, task, action, result. Mention specific tools such as pivots, lookups, Power Query, SQL, sensitivity tables, dashboards, and measurable impact. Question 9. How do you build a financial forecast when historical trends are no longer reliable? When history is unreliable, I move from trend-based forecasting to driver-based forecasting. I identify the variables that truly move results, such as account growth, transaction volume, rate assumptions, credit losses, or staffing levels. Then I build base, upside, and downside scenarios using business input and external indicators. The key is transparency. Every assumption should be visible, testable, and easy to update. Forecasting becomes less about precision and more about decision readiness. While answering, focus on driver-based forecasting, external indicators, scenario analysis, business input, sensitivity testing, clear assumptions, and updating the model as new actuals become available. Question 10. What is the efficiency ratio, and why does it matter for a bank? The efficiency ratio measures non-interest expense divided by revenue, usually net interest income plus non-interest income. A lower ratio generally means the bank is generating more revenue per dollar of cost. For example, if expenses are 60 and revenue is 100, the efficiency ratio is 60%. It matters because banks must balance growth investment, technology spending, compliance, and branch costs with profitability. I would compare it over time and against peers, not in isolation. Make sure to define the formula, explain interpretation, connect it to cost discipline and operating leverage, and note that business mix and investment cycles can affect comparisons across banks. Question 11. How would you explain complex financial results to a non-finance stakeholder? I would start with the business question they care about, not the spreadsheet. Instead of saying expenses were unfavorable by multiple account codes, I would say costs were above plan, mainly because hiring started earlier than expected and vendor invoices were pulled forward. I would use a simple bridge chart to quantify each driver, and then explain what it means for next month or the full year. The goal is clarity, action, and trust. In your answer, emphasize audience awareness, simple language, business drivers, visuals, key takeaways, implications, and recommendations, rather than overwhelming the stakeholder with accounting detail. Question 12. What controls would you apply before sending a financial report to senior management? Before sending a senior management report, I would verify that the data ties to approved sources, such as the general ledger or official planning system. I would check formulas, refresh links, compare totals to prior versions, and review unusual variances for reasonableness. I would also confirm commentary with business partners when needed. Since banking data can be sensitive, I would check distribution lists and confidentiality. Good finance work is accurate, controlled, and explainable. Be sure to cover data source validation, tie-outs to the general ledger, formula checks, version control, variance reasonableness, review trails, confidentiality, and sign-off from relevant business owners. Question 13. How would you prioritize your work during quarter end when multiple teams need analysis urgently? I would first identify which requests are tied to hard deadlines, senior management decisions, regulatory reporting, or material financial impact. Then I would clarify the minimum analysis needed versus nice-to-have detail. I try to communicate early. If two urgent requests conflict, I tell stakeholders what I can deliver and by when. During quarter end, speed matters, but I would not sacrifice core controls. Prioritization means focusing on the highest risk and highest value work first. While answering, focus on understanding deadlines, materiality, stakeholder impact, regulatory or management reporting priority, transparent communication, quick triage, and maintaining accuracy under time pressure. Question 14. What is CET1 capital, and why should a financial analyst at Bank of America understand it? CET1 capital is a core regulatory capital measure, mainly common equity, compared with risk-weighted assets. It shows a bank's ability to absorb losses while continuing to operate. A financial analyst should understand it, because growth is not only about revenue, it also consumes capital. If a business adds risk-weighted assets, the return must justify the capital usage. CET1 also affects stress testing, dividends, buybacks, and management's flexibility through economic cycles. Make sure to define Common Equity Tier 1 capital, risk-weighted assets, regulatory resilience, stress testing, capital return, and why balance sheet growth must be evaluated against capital constraints. Question 15. Describe a situation where your analysis changed a recommendation or business decision. I once reviewed a proposal to increase spending on a project that looked underfunded based on budget variance alone. After breaking down the variance, I found the issue was timing, not insufficient budget. Invoices had arrived earlier than planned, while future months would be lower. I recommended holding the annual budget flat, but updating the monthly forecast. That prevented an unnecessary funding increase and helped the team focus on cash timing and vendor scheduling. In your answer, use a concise story with the original assumption, your analytical approach, evidence found, recommendation made, stakeholder reaction, and measurable result or lesson learned. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.